Rowe Price is a dividend aristocrat that has recently seen a very sharp drop in their stock price, as you can see here by the fast graph. Their stock price over the last year or so has fallen over 47%. The company on the long-term graph appears to be significantly undervalued, but in this video we're going to see how undervalued or fairly valued the stock really is. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool. Welcome you to my video on Rowe Price. It's a dividend aristocrat, one of the highest quality dividend paying stocks out there. It had 36 consecutive years of increasing their dividend. And what I'm going to do here is kind of go through a deep dive into Rowe Price. And I'm going to first of all look at it from a historical perspective, but then finally I'm going to go into the future because, as I've said so often, you can learn a great deal from the past, but ultimately you have to invest in the future. So let's go ahead and get into the presentation and look at Rowe Price. Now, the first thing I want to do here with this is maybe because some of you aren't really familiar with fast graphs and how it works. So I'm going to go ahead and kind of give you a quick introduction on how the tool is designed and how it works. The first thing here, we have numerous metrics that we offer. We have earnings, three different versions of earnings, including GAAP. We have EBITDA, sales, operating cash flow, free cash flow. And as I go through this presentation, I'll go through all of them. But for now, I'm starting out with adjusted operating earnings. And you can see the company has grown earnings at 13.01% over the long run here. By the way, it's done that very consistently, but there have been times when the earnings have faltered. For example, their earnings fell 24% in the last recession and 9% in 2009. 2008, they fell 24%. They fell 9% in 2009. That's kind of important because, it looks like it's very possible that we could be on the verge of a serious, economic situation coming up. We've got rampant inflation. The Federal Reserve is raising interest rates. That's obviously had a negative effect on the stock market and partially explains why the stock is dropping, but I'll save that for later. The point is they have a very good long-term record of growing earnings. Now, the next thing that I will put on the graph is the dividend, because the dividend is critically important to the company. And I'm going to do the dividends and the payout ratio. So this white line represents the dividends each year, and the area below the white lines illustrates the amount that the company has paid out. So if you're looking right here, you can see if I point to this, in 2018, they paid out about 38% of their earnings to their shareholders in dividends. These spikes that you see here, because this is a company that's increased their dividend for 36 years, these spikes show special dividends that they paid. Now, the payout ratio, for example, in 2012 was over 70%, but that included a special dividend. I'll get into that. Now, the way the fast graph works is we show the dividends here relative inside the earnings before they've been paid out, and then we simultaneously show the earnings after they've been paid out to the shareholders. And the idea here is this is to illustrate the point that when I add monthly closing stock prices to the graph like I did here, and then what you see is you get capital appreciation, which is a function of the price going from point A to point B, or even price depreciation if the stock price is going down, but then plus you get the dividend income. So we're just simply metaphorically illustrating that both components of total return, the capital appreciation, if any, and the dividend, if any. So what this orange line also represents is a fair valuation reference line based on theoretically what a company with these certain growth characteristics of earnings ought to be trading at from a standpoint of using discounted cash flow formulas or oriented formulas. It's kind of discounted cash flowing in reverse, if you will, when you're looking at the historical graph. But then we also add a second valuation reference line, which we call the normal PE, which is simply the PE that the market has applied most commonly over the time frame that we're drawing. Now, what I want you to note here, right now I'm showing a normal PE of over 20. If I shorten this time frame, for example, to 15 years, which includes, a couple of years of forecast, 2 3/4, if you will, or 2.5 years of forecast almost, what you see here is the normal PE now has fallen to 17. This adjustment, this valuation adjustment, here we see the normal PE trading at the theoretical fair value PE of 15. So that's one thing that we'll be looking at a little closer as I go through the presentation. But so far, what you're seeing is that the stock price tracks earnings. You can see periods of high valuation followed by periods of low valuation. And you can see when it's, theoretically trading just right. Now, based on this historical picture here and on this 13% growth rate, which, by the way, is also dynamic, you'll notice when I draw it at 15, it's actually 14.5%. If I draw it for the last 10 years, which includes some estimate years, it drops down to about 10.7%. So, everything is mathematically driven and derived here when you're using this tool. I call it a tool to think with. Now, it looks like the stock is significantly overvalued here based on earnings. So before I leave this historical graph, I want to look at the company historically from some other perspectives. Let me go next to GAAP earnings. Now, GAAP earnings are, they also include non-cash charges, one-time events, things like that. And you'll notice that the company has almost a very similar or almost identical record, based on GAAP. What GAAP can show you is if the company's doing a lot of transactions or a lot of, accounting and making a lot of accounting adjustments. It just gives you a sense in what the company's doing. We prefer adjusted operating earnings because it's more of a cash flow metric than the diluted earnings because they can include non-cash charges. So then I go into operating cash flow. Now, this is critically important when you're looking at dividend aristocrats or dividend growth stocks, because here what I'm looking for is the company generating enough cash flow. I don't necessarily care as much about price here, although there is often a very good, strong price correlation between cash flow. I'll simply recognize that if I see it. But the point is, what I'm really focused on here is, do we have the operating cash flow that's covering the dividends? And then the real acid test is always free cash flow. This is money left over, after they spent everything they needed to run the business. And the company also generates free cash flow above and beyond what they need to, cover their dividends. Again, you won't see nearly the correlation between operating cash flow and the stock price, but you will see a partial correlation. Then we have EBITDA, which I consider another form of cash flow. It's earnings before interest, taxes, depreciation, and amortization. And so far, if you look at it from the price perspective, I do want to point out, I also have EBIT, and then I also have price to sales. And so, price to sales here is also very important. You can see that sales have grown by just under a 10% rate, but that includes the estimates, which are actually going to be quite lower than that expectation, which I'm going to get into in a few moments. So now I've looked at this company over all these metrics, and I see a picture of the stock being fairly overvalued. Okay, I also like to check the performance of the company and compare that to the market. And this company long-term has outperformed the market dramatically. It's paid significantly more dividend income than the market. It's generated significantly more growth or capital appreciation than the market and generated an annualized rate of return significantly higher than the market in both without dividends and as with dividends. So it's had a strong advantage. Owning this stock has given you a great advantage over the S&P 500 over the years. Okay, but now I'm going to go into what we call fund graphs, which stands for financial underlying numbers, and take a little deeper dive before I get into forecasting here. It's important. We're going to be launching this health check very soon, and this is a tool that allows us to really look at how the company compares to its peers on some very important metrics. Now, from a standpoint of operating margin, gross margin, and net margin, the company fares very well. They've generally outperformed their peers. The black line on this graph shows what other companies in this sector or industry have performed at. And as you can see, Rowe Price has done, extremely well, and they've been, generating 45 to 48% operating margins, which I think is very strong for a company in their sector. The returns on assets have also been very strong relative to the norm in the industry. The returns on equity have also been very strong. Their sales revenue growth has grown, I showed you earlier, between 9 and 10%, 10.59% for these historical years, not counting estimate data. Net income has also grown at about 14.6%. Those are really attractive numbers. The company is able to get a lot out of their assets. They have one of the higher asset turnover rates of any company. Operating cash flow has significantly been higher than net income, which I think is also a nice thing. And then debt, the company virtually has no debt. Now they do show we do have some debt. They have around $200 million of debt. So if I go into the balance sheet, I'm going to be able to see that the company does have a modest amount of debt, but they also have net debt. When you add in the cash and the short-term investments, the company actually ends up with net debt. So the company's position on debt is extremely strong. Now I can go through all these financial statement items. I can also go through all these profitability ratios with you. I went through a lot of them. That's what the health check was designed to do. But I just want to simply make the point that this is a very strong company. And if I go back to the fast graphs here, it's fiscally, fit. The company they have no credit rating. They haven't applied for one, but they only have 2.29% debt to capital, which is very attractive. They currently offer a 4.18% yield. And remember, they've had 36 consecutive years of increasing their dividend. The blended price to sales ratio is 3.49. It's historically been about 5.65, so that would indicate that it's undervalued. From a standpoint of earnings, you can buy it at a 9.6 blended PE ratio, which I believe is significantly almost a third or more lower than what it ought to be. Again, it has a 4.1% dividend yield if you bought it today, and a very strong earnings yield of over 10.3%. So at this juncture, I think you would have to obviously agree that this really looks like an excellent investment, an excellent long-term investment. Now we're going to test that hypothesis a little bit by going into the forecasting calculator. Okay, now one of the things that I want you to note here is that there are around 9 or 10 analysts that report to FactSet, which is where we get our data. The company has an exceptional scorecard. They've really performed beautifully, on their 1-year forward forecast. They've virtually, hit or beat estimates virtually 100% of the time. They've hit them 54%, and they've beat them 46% of the time. So, bottom line is the company has a very strong record. Now, what I want you to take note of, though, is you can always, learn from the past. This company has a great record. They're one of the premier investment managers in the country. But, the Rowe Price mutual funds, et cetera, they also do private management and other things. I'll get into that a little bit more here in a minute. But the point is, looking to the future, analysts over the next couple of years are not quite as sanguine about the company as they've been. Now, but let's analyze that. Let's figure out what that is using the tool here. First of all, they do expect a down year this year. Assets are expected to drop. The tool automatically coordinates the dividends to go along with that. With this company's record of dividend, I don't know that that's practical, so I would actually ignore that. What I would look at, really here is what the earnings power of the company is. So we have negative earnings this year, which, by the way, is important to understand, because when a stock is trading like Rowe Price was at very high levels, way over what, rational valuation models would suggest, that's when the stock becomes vulnerable. Now, the bad news is the company's, expected to have a down year. And again, I'll get into that more here in a moment. Now, one way that I'm able to corroborate that kind of thing and to try to evaluate that kind of thing is I go to the external links on Fast Graphs. I can click this, and I have access to several other research sites, including the company's corporate website, which I'll get into here in a moment. But for example, I can go into a site like Seeking Alpha, and I can look at crowdsourced articles that analysts and investors have written on the company. I can also see news. And of course, first thing that strikes me here is that, their stock price slipped as April assets under management slid to $1.42 trillion. Now, they did declare their normal dividend. Again, their cash flows are really well protecting their dividends. They don't have much debt. The company has a lot of financial flexibility, and I'll talk more about that here in a moment as well. But the point is, I'm looking at here and I'm going to read some of these articles. So I'm going to just now, obviously summarize how I would go about researching. So that's one place that I would go into. I would go into websites like Seeking Alpha, et cetera. I would also go into the company's corporate website, and, I would try to learn as much as I could about the company here. And, they've got a lot of information. I've read that information. I'll, again, leave that. I've gone into an investor day last year, a year ago, and the company has slides, and they talk about, what their management's vision is, what their expectations are, what they want to be, how they want to be it. So I learn about as much as I can, including I get, again, a review of what I've shown you already on the fast graphs. Now, there was another announcement on October of 2021 that's very important here to this discussion, and that is they purchased Oak Hill Advisors, which is a company that does a lot of private deals and so on, and alternative investments, if you will. And they've spent about $4.2 billion, I believe, was the number on that. And what they're looking for is methodologies to diversify their business and kind of grow their business. So I'll go through all this kind of information. Then, also in additionally to that, in fast graphs, I'm a subscriber to Morningstar. I would go into Morningstar, which gives the company 4 stars, by the way, and I would, review Morningstar's analysts, and I'll just highlight some of the things that Morningstar is basically saying here. I won't read the whole thing. I've read the whole thing. I won't read the whole thing to you. But for one thing, they talked about they lowered their fair value estimate to $165 a share. Now, interestingly, if you use the fast graphs and look at what the company's normal multiple is and what the price would be, you get pretty close to Morningstar's $165 number. But remember, that's an opinion. That's not necessarily a fact, okay? But regardless, Morningstar has lowered it. They talk about it's highly leveraged to growth equities. Now, the company does not have a lot of leverage, as I've already alluded to. What they're saying here is, but they are very, heavily dependent on growth stocks, okay? And which means that market losses are likely to remain elevated, because if we go into this bear market that's starting to look like it's unfolding right now, that could, be bad. Now, they also talk about organic assets under management growth. They think is going to be very small. One of the things this company has done is it's been one of the best at, rather than making acquisitions. So the Oak Hill deal is a little bit out of character for them, but they've typically grown their business very nicely through organic growth, but that's going to be a little tougher for the next couple of years. And then, they also talk about the fact that, there's a possibility that they would generate negative compounded annual growth of revenue over the next year or so. Now, these things are important when you're evaluating the company, because I want you to understand that, we're looking at investing in the company in the future. The company on a historical basis, as I've already, I think, demonstrated quite clearly, is dramatically undervalued. But what does it look like going forward? So, I'll go through here and read this whole article. That's one of the parts of how I do research. And again, I'm not going to bore you with that. I also turn to other sources. Like, for example, I also subscribe to Zacks. So I'll go into Zacks, and Zacks talks about, quite a few things about, Rowe Price that, that they believe is good. They think launching investment strategies, enhancing client engagement capabilities, and investing in advisory services will drive long-term growth. Zacks also opines that the company's strong assets under management balance and a mix shift towards international growth funds are also going to be things that will help, grow their revenues. Now, here's the rub. If I go back to the forecasting graph here and I look at long-term growth as reported by FactSet, I get a negative number. Now, I can check that. I can also go into external links here and look at Yahoo estimates, okay? And what I find here is Yahoo gives me estimates of 12.6% growth and 5.9% for next year, but 12.6% growth over the next 5 years. That's what they're currently estimating. So what I've done for you here is I've gone into the custom calculator here of fast graphs, and I've put in the current estimates that I get from FactSet. They're looking at a minus 18% earnings growth for this year, followed by about 6.69% for next year. And then what I've plugged in, I've used the customization, I've plugged in the 12.6% growth rate that Yahoo estimates to take a look at what it would look like with a more optimistic viewpoint. So I've got 2 viewpoints here. I've got one really negative viewpoint and I've got one really positive viewpoint. Okay, and I think that's important. So if I go back to this negative viewpoint, if I did apply, a 15 PE ratio, this stock still looks like it would be attractive, assuming that, they're able to continue to pay their dividend. And I think that's obviously a real possibility. I think this company's totally committed to paying their dividend. All right. And, and to, talk a little bit about background about the company. They were founded in 1937, headquartered in Baltimore, Maryland. The company is a global investment management firm. I think that's also important. They provide a broad array of mutual funds, sub-advisory services, separate account management for individual and institutional investors, as well as retirement plans and financial intermediaries. And now, with the addition of the Oak Hill, partnership that I referred to, that also gives them, a entree into alternative credit products and other alternative investments that could help them and, possibly fuel their growth going forward. So the company does have, some very interesting possibilities. If the optimistic view from Yahoo analysts, that I think Yahoo gets their data from Reuters, if I'm not mistaken, indicates this is a very strong rate of return going forward. So the point is, I'm looking at the yin and the yang, if you will, trying to run what-if scenarios and, try to, see what I think about this company. Now, to review the strengths, the company basically is debt-free with substantial liquidity. That gives them a lot of flexibility. The company has a very strong management team. Their track record has been exemplary. They've proven, that they're adept in the industry. They have also recently increased their common share repurchase authorization by 10 million shares. I think that's important because they're looking at taking advantage of the low valuation that the stock is currently trading at. And the capital deployment activities the company is forecasting, look very sustainable for the long term. So all in all, as I look at this company, I would argue this. It has a tremendous historical record. It has a proven management team. This is not the first time the company's gone through a recession, and it probably certainly won't be the last time. They're a formidable company. They have, I think $1.4 trillion or so under management. That has dropped a little, but it's going to, I imagine, regenerate and grow again as this company produces one of the better track records of any money management firm in the industry. So all in all, if you were ever going to buy Rowe Price, the point is you wouldn't want to buy it when it was overvalued because of the negatives I mentioned. No matter when in history, the periods of high valuation were always, weak periods to be investing in the stock. Whereas periods of undervaluation, even during the, difficult times in the company, were always much better times to invest in the stock. I'm just arbitrarily picking numbers here for you. I'm using the calculator function. That's something else that you can do with fast graphs, is you can check and see the effects of things like high valuation, et cetera, and what it does. So the idea here is to have a tool that will help you research stocks deeper and faster. Personally, I really like this company. I think, it's got a great long-term opportunity and story, if you will. If I look at it from the standpoint of, investing in it today, it's already looks like it's starting to recover. Of course, we have a little better market than we've had over the last several days. But this company does have a lot going for it. It's very cheap. It is a Dividend Aristocrat. The company's proven themselves over time. When I go through the cash flows and the fundamentals and the balance sheet and the financial statement, they have tremendous liquidity, a very smart management team, and all in all, I think, you would be wise to maybe start looking to build a position in Rowe Price for the long term. But be prepared to, go through some hard times with the company possibly in the next year or so before things start recovering. Anyway, this has been Chuck Carnevale saying thanks for watching. I hope you enjoyed this kind of deeper dive into Rowe Price that I promised you. But I also wanted to simultaneously show you how I use this powerful research tool, Fast Graphs, the Fundamentals Analyzer software tool, to allow me to go in and look at the company. Now, I do a lot more than I've showed you in this video, but I've just kind of highlighted everything for you. There's absolutely never, ever a substitute for comprehensive research and due diligence. And you just can't look at the past. The past is not necessarily indicating the future, but yet on the other hand, don't just totally discount the past either, because, companies that have proven their mettle, there's a lot to say for that. So, as a long-term investor, I'm looking for those kind of companies. I hope you enjoyed this video. If you did, ring the bell, subscribe to the channel. And if you haven't already, you ought to take a hard look at Fast Graphs, the Fundamentals Analyzer software tool. I wouldn't even think about investing without it. Anyway, thanks for watching. Talk to you again real soon.